Hi, I know everybody is essentially waiting for me to do a coverage of Alibaba's latest earnings quarter, and here it is, so let's not waste time. Remember to help gently tap that like button as well on the way out. Also, this video is sponsored by Weibo. So in case you didn't know, from now until the 1st of September 2022, every single new signups can get up to $100 worth of Google shares. So I will leave the link and instructions down below. So essentially, you just need to deposit a minimum sum of 2,000 Singapore dollars and execute a total of 6 trades in the first 30 days. So 100 USD reward for depositing around $1,400. So that's an 8% ROI in 1 month. Definitely better than Alibaba. So jokes aside, Weibo also allows for investing into fractional shares. And I don't know why this is not a common feature for most brokerage. So they pride in zero commission trading as well. So don't let this 8% ROI deal get away. Link in the description box down below. So anyhow, to really look into Alibaba's recent earnings call, I think we have to keep in mind a few of the key factors. Because I believe some investors tend to forget or tend to commit this kind of cognitive dissonance where they really consume a lot of negative news headlines from a lot of your Western mainstream media or even other media outlets telling you that, China pandemic controls, consistent and persistent lockdowns, China bank run problem, property crisis, etc., etc. So the list goes on. So out of the whole myriad of different issues, this is the current context of China. So just keep this context in mind when you go through every single earnings report or every single quarterly results. So based on that fact, if you were to observe the last 2 or 3 quarters, there was nothing really extraordinary. There really isn't anything that surprised us to the upside or the downside. In fact, I think it has been pretty disappointing for many hopeful Alibaba back holders thinking that Alibaba is able to turn around the corner. But that being said, if you were to reconcile a lot of all these earnings call or quarterly report with many of its counterparts like JD, Pinduoduo or Tencent, all these are big giant conglomerates as well. Essentially the whole basket of these Chinese big tech companies or conglomerates, they are painting exactly the same picture. So I don't exactly understand what this group of investors are hoping for, hoping that Alibaba is able to be the one, the shining star, and the rest of the companies basically just shitting their pants or something like that. I think it's far from the truth, and it's not very pragmatic to have that kind of thought process. So just looking through based on consensus and analyst estimates, Alibaba did beat on all fronts: revenues, EBITDA, EPS, and even free cash flow. But that said, I think rather than just looking at it from whether Alibaba beat expectations or not, we have to scrutinize these expectations in the first place. And you can tell that after scrutinizing, you understand that a lot of all these expectations are just expecting Alibaba to be a very bad quarter for them. Like I have repeated multiple times, the headwinds are incredible in China in the context of whatever that's transpiring. So many of these consensus and estimates are downgraded multiple times and by huge extent and margin. So just looking at Alibaba's recent price movement, after the earnings call, it essentially bounced above $100, but it was extremely short-lived. People thought that, Alibaba essentially beat everything, but upon further consideration, actually the quarter was just meh. And if I can summarize the entire earnings report, I'll just summarize it within 2 words. It's a nothing burger. Oh wait, that's 3 words, but yeah, you get my point. So looking at current consensus, moving towards the entire year to cover all the way to 31st of March 2023. So if you were to understand, based on the first quarter of the financial year where Alibaba reported a flat revenue, so in order for them to achieve this 5% growth, that would probably mean that in the upcoming 3 quarters, they probably have to grow top line by minimally around 7 to 8% in order for them to smoothen the entire year's performance to 5% odd. So now, I will throw back the question to many of all you Alibaba back holders as well. Do you think Alibaba is able to hit that mark? And do you think whether the current consensus on Wall Street is fair? Do you think they're too optimistic? Do you think they're too pessimistic? I think I'll leave it up to you to decide as well. So moving specifically into Alibaba earnings, Daniel actually professed, during the past quarter, we actively adapted to changes in the macro environment and remained focused on our long-term strategy by continuing to strengthen our capabilities for customer value creation. Following a relatively slow April and May, we saw signs of recovery across our business in June. So we are confident in our growth opportunities in the long term, given our high quality consumer base and the resilience of our diversified business model catering to different demands of our customers. So we will go much deeper in depth after going through the entire earnings call transcript in the later part of this video. So we will try to break down what Daniel has to say, but there's a lot of business fluff language here that basically means nothing. So I think we should be more grounded in terms of numbers and projections. I think those are more beneficial to us as shareholders. So looking at top line revenue, essentially stayed flat. So there's a decline in terms of the core commerce section revenue by 1% year on year. I think in the presentation slides we'll have a better breakdown and understanding. So income from operations also decreased by 19% year on year. But I understand a lot of you don't really care about income, whether is it net income, EBITDA, etc. because many of these numbers can kind of be manipulated. So I guess free cash flow, or in terms of cash flow from operations, would be a better yardstick or criteria when judging how good they've performed in the quarter. The good news is, at least from the net cash provided by operating activities, it was up 1% and free cash flow was also up 7%. So going to the presentation proper, I was quite surprised at why they didn't provide the breakdown in terms of the annual active consumers. So there was some speculations online that Alibaba might have experienced a negative user growth. That's why they essentially eradicated this page totally. Personally, I don't think so. Maybe the numbers might not be good, but I don't think Alibaba is that matured to the point where they are currently experiencing negative user growth. So anyhow, just looking at the financial highlights, like most investors of Alibaba, I couldn't care less about other business segments. I think there are only three core pillars that we have to look at. Number one, China commerce. Number two, cloud computing. And number three, Ant Group. So let's look into these three specific segments. So for China commerce, year on year, it decreased 1%. But I think this 1% might be a little bit misleading. Misleading to the upside, by the way. So I think this is fairly optimistic. I think after going into the breakdown in that particular presentation slide, you'll understand what I mean. For the second part, I think for cloud actually only grew 10% year on year, and that is severely disappointing. But that being said, like I said, if you're to keep the context back in mind, when the entire economy is in pretty bad shape and a lot of the companies out there are also experiencing some prudent cost control measures, you can understand why this digitalization effort is kind of slowed down. And a lot of people like to compare, oh, look at AWS, oh, look at Google, oh, look at Microsoft Azure, they are growing at 30-40%. The issue is a lot of all this cloud provider in China, they are probably only doing China's business. Arguably, they are probably in Southeast Asia as well. So the Malaysian government is one of the customers of AliCloud. But that being said, I think in terms of total addressable market, in terms of their penetration, in terms of their available customers, you can understand why is there a considerably slower amount of growth rate. And if the entire driver of the cloud business is from China, and if China is slowing down, you can draw a direct correlation. And it's not as if like AliCloud is the only one slowing down. If you were to compare to Tencent Cloud as well, I think based on last quarter, Tencent Cloud and plus their financial arm only grew 10% year on year. So that's just some perspective and context. Rather than just making a sweeping statement saying that, oh, AWS and Microsoft Azure can do this and why can't Alibaba Cloud? So that's just some nuances. I think another point to note in terms of Ant Group, so if you're to search for Ant Group, I think thankfully, one thing is in terms of share-based compensation, you can see that there is a huge reduction in terms of share-based compensation. And personally, as an investor, as a retail investor at least, if the company is not even doing well, please remember to be more prudent in terms of awarding compensation. And I guess that's something that they kind of did well compared to other companies. I'm not going to name names here, but yeah, you get my point. Anyhow, looking at the share of profit contributed by Ant Group, you can see that there is also a significant drawdown and impairment on a year-on-year basis. So this is actually a 17 to 18% reduction in terms of earnings attributed by Ant Group. And I guess many people will come to the conclusion that, hey, this is probably the result of the crackdown. I beg to differ. I think the bigger concern is really the macro headwind here, where people are consuming less, people are spending lesser, people are not as optimistic of their future, people are losing their jobs, they're not taking up as much loan, they're not doing more investments aggressively, they're not insuring themselves, etc., etc. Now, I think if you were to look at the entire cost structure, based on the previous quarterly earnings report, you understand that Toby, who is the CFO of Alibaba, has been talking about optimizing cost structure and doing cost control and essentially trying to fire off dead weight. And just recently, Alibaba just fired around 10,000 of their employees in the most recent quarter. So even on the sales and marketing front, they have been reducing a lot of their expenditure. But I think for the rest, in terms of cost of revenue, product development, and G&A, for G&A, they probably can do a much better job, but I think for product development, essentially for the R&D aspect, they will have to continue spending money to essentially to accrue more business value and by translation, accrue more shareholder value. So if you were to zero into China commerce alone, if you were to look at the top line, revenue did decrease by 1% year on year. But I think the more concerning factor is really this main revenue driver of customer management. So CMR, customer management revenue for short. So if you were to look at customer management represents around 72 billion RMB of Alibaba's business. So 72 out of 205, that represents around 35 to 40% of the entire group's revenue. But that said, for the vertical of customer management, it's the most profitable arm of Alibaba because it's essentially just commission and take rate. And for commission and take rate, the margins are incredibly high. So you can see that even though top line revenue for core commerce alone is down 1%, but the adjusted EBITDA is down 14% because of this huge part. Regardless of whether China commerce wholesale is up 26% or direct sales is up 8%, the margins are not as high as the customer management segment. So which is why the adjusted EBITDA and bottom EPS is going to be hit adversely. And this is a call for concern because initially, I think based on the last few quarters, if you to compare back in 2021, CMR is experiencing some sort of headwind. But I think in terms of growth-wise year on year, it was probably mostly flat or down 1%, down 3%. And this time around, it's down 10%. And we have to dig deeper into understanding what's the causes of this and what's the explanation of management. And there is, in the later part of the video, talking about the earnings transcript. So just keep this bookmark in the back of your mind. So moving on to the next part where I think most investors are most concerned about, which is Ali Cloud. I honestly have nothing much to explain, and it feels like I'm trying to defend for the company or the country. But if the country's outlook is bad, it is bad. And there is some concerns from analysts, from some banks during the earnings report as well. And I think it shows more color in that presentation and the discussion. So I'll leave it to that. So just some backdrop as well, in case many of you guys are wondering. So if you were to look at what Daniel actually said, so they saw signs of recovery across their businesses in June. So it was a slow April and May. And if you were to look at a quarter, April, May is the first 2 months of the quarter and June was the recovery. So Daniel also briefly spoke about July, and he said that July was riding onto the good momentum in June. And just looking at July alone, if you were to look at a PMI, the manufacturing PMI is 49. And anything below 50 means that there's a contraction. But that being said, I think for non-manufacturing, for example, like service industry, etc., there is a huge recovery. But I think banking on the hope that China will have a great recovery in the second half of 2022 is pretty much just hopium. And also, I think just to pivot to the infrastructure spending in the cloud sector, Alibaba is still ranked 4th in the entire world. So currently it's in the international arena, AWS, Microsoft and Google Cloud are the 3 main titans that are fighting it out amongst themselves. But in China alone, I think it's safe to assume that many of all these local consumers, enterprises, especially state-owned ones, will have no dealings with your top 3 cloud providers. So I think the conundrum for China cloud sector is this now. Simply put, we know that the adoption or digitalization into the cloud space is unstoppable. Every single country, every single industry, every single enterprise will go into cloud adoption. And we know that it's the same for China's case because the whole world has already shown us, especially for all your Fortune 500 companies, has already shown us that if you want to be a top tier company, you want to have competitive advantage, you have to go into native cloud infrastructure. The biggest issue now is we know the goal, we know the process, but we don't know the timeline. And a lot of people are just betting on this timeline and essentially the potential of this China cloud market. And even though there might be a lot of estimates, a lot of consensus by analysts and a lot of projections, at the end of the day, it's still adoption and execution. So I think I'll just leave my 2 cents at that. So I think to the last part of this earnings call, I just really wanted to briefly run you through the entire earnings call transcript between the management and also some analysts from different banks as well. So I think many of the essence can be inferred from how management is positioning the questioning and the answers. And more importantly, it gives you some insights in expecting the forward guidance. So Daniel started off this entire discussion saying that we have delivered stable results after overcoming challenges in an extraordinary quarter. So I don't know why. I think this is the first time he actually used extraordinary quarter. Clearly, this is one of the slowest pace and it's the slowest growth in Alibaba's history. And he's probably very proud of delivering stable results. So despite the soft economic conditions, we managed to deliver stable revenues and narrowed losses in our several strategic businesses by improving operating efficiency. So this idea of improving operating efficiency and optimizing cost structure has been rinsed and repeated in the previous quarter as well. And ideally, this will be the common theme moving forward in the entire year itself. So in the 12 month ended June 30th, more than 123 million annual active consumers each spent over 10,000 renminbi on Taobao and Tmall, representing a retention rate of approximately 98% compared to the prior 12-month period. So there are 88 VIP members, which is essentially like Amazon Prime. Alibaba's most important premium users continued to grow at a healthy rate to 25 million by quarter end. So of course, if you have the context of China slowing down, yet at the same time, if Alibaba is still able to deliver stable returns or stable growth rate, then I guess it's arguably good. But that being said, if a superior company with a great economic moat will be able to tide through many of these storms, and despite whatever China is doing or whatever the US is doing, if they are still able to continue growing top line and bottom line, and that will probably be a wonderful company. But from what I understand, at least in the last quarter as well, after looking at a lot of all these big tech earnings in China today, I don't think many of them are doing that well, and Tencent also reported stable earnings in the previous quarter. So I look forward to how all these different Chinese big tech companies are reporting for the upcoming quarter 2 of 2022, but I think it's better to manage expectations as well. I think the more worrying factor is really this idea of competition. So Daniel did say, we are aware that the overall growth of Taobao, Tmall's GMV was below China's retail sales growth in the past quarter, as we experienced increasing fierce competition among various formats of e-commerce. So this idea of increasing competition, and if the business really have a superior economic moat, they do not have to worry about competition. But that said, I think it's still too early to tell, even though they have been attributing a lot of their missed revenue growth because of competition. But one core part of the equation for this sort of revenue growth has to be longevity. So I do understand that many of these other platforms or competitor platforms out there are essentially just burning through their cash and burning through money to essentially try to compete with Alibaba. And none of these e-commerce businesses in China today is as profitable or has such a high margin compared to Alibaba. So that's why I floated this idea of longevity of growth. So Daniel personally also echoed the same sentiments. Our current scale is much bigger than our peers, and more importantly, our advantage in profitability is even larger. So going on to cloud, our cloud revenue delivered 10% growth year over year during the quarter. The slowdown in revenue growth was a result of multiple factors, including slowing macroeconomic activities, declining in revenue from the top internet customer, softening demand from China internet customers, and a delay in parts of our hybrid cloud projects due to the impact of the resilience of the pandemic. Contributions of cloud revenue from non-internet industries was 53% in this quarter, up more than 5 percentage points compared to the same quarter last year. Like I mentioned, we know the goal, we know the process, we don't know the timeline. Now, to circle back to the customer management revenue, which is the core business of Alibaba, Toby, who's the CFO of Alibaba Group, said that Taobao and Tmall's physical goods paid GMV decreased by mid-single digit. So CMR growth lacked GMV growth this quarter, mainly due to higher order cancellation as a result of logistics bottling from COVID-19 resurgence and restrictions that resulted in supply chain and logistics disruption in April and most of May. So if you were to further break down the customer management revenue growth into advertising and commission revenue recorded mid-teens decline due to higher order cancellation. So if you were to circle back to the China commerce revenue breakdown, this negative 10% year-on-year decrease for customer management mostly was probably attributed to the orders cancellation, and it's a result of this bottleneck in supply chain. So this mid-teens decline is a huge impairment to the top line, which also explains why it's so flat in the quarter itself. And at least the quote-unquote silver lining is, if China managed to pull themselves out of this entire pandemic control issue, at least for next year in 2023 in the same quarter, there will probably be this low base effect kicking in and top line might grow by a huge extent. So moving on to the Q&A section, an analyst from Goldman Sachs actually asked Daniel, or quizzed Daniel on, I'm wondering if you could tell us more about the signs of recovery you're seeing in terms of GMV and CMR. So Daniel replied, we continue to see this positive trend of recovery continuing through July, and we expect that July will be even better than June. And this comment was made in August, and they have already seen the results. So they know for a fact that, hey, July will be better than June. I think the core concern for many investors and analysts alike is really this idea of how effective is this pandemic control, and would we go through this entire perpetual lockdown cycle again. So Daniel did add on, but one data point that we pay a lot of attention to is the consumer spending as a proportion of disposable income. So for the first half of the year, it was 64% as compared to again 69% in the previous year in 2021. So certainly, although we are seeing signs of steady recovery in consumption, I think it will take more time for it to fully play out and for consumer confidence and sentiments to fully recover. So Daniel is essentially just trying to dampen expectations and not tell people to bid up the share price and not get too excited for this recovery. So next up, speaking about cost optimization, I think this was a fairly interesting reply from Daniel. So he said, pursuing cost optimization and driving efficiency is not a decision that's primarily driven by financial considerations. Rather, it's very much informed by a strategic choice and our judgment of the overall macro environment that we find ourselves in. So this also includes the 10,000 people that they just retrenched in the recent quarter. And it feels very much like what Daniel is trying to tell the CCP and how they've been governing the country thus far. And because of the headwinds and the pressure expected to the business top line and bottom line, that's why they are mapping out this sort of financial prudence and financial engineering to their entire business itself. So now moving on to Alex Yao, who's our favorite analyst. So he asked, but are you seeing the pace of digitalization playing out more slowly in some segments than others? Daniel replied, they are intending to build a complete consumer matrix. So the most valuable asset that Alibaba has as a company is the consumer mindshare. We don't need to be paying money to induce the customer to come back. And we have that mindshare of the customer, and that's what's capable of driving a lot of organic traffic, that we get customers coming back even when their willingness to consume may have weakened during the pandemic period coming to us. And similarly, this is the same argument for customer management revenue. If Alibaba is able to spend lesser than competitors, while competitors are continuously bleeding money in terms of marketing, in terms of promotions, in terms of trying to cost cut, then at the end of the day, we have to understand the longevity of this growth for many of their competitors are not sustainable. So that's just some 2 cents. I think to the last part, asking about growth in the cloud sector. So as we look into the second half, how would you think about the growth opportunities on the cloud business? So Daniel replied, I think if you have to look at the IT expenditure, as a percentage of total GDP, I think China is far below like US or some developed countries. So I think that's the biggest landscape. And the second biggest thing is I said actually industrial digitalization is a trend and all the companies, all the sectors across industries, across sectors digitalize. So I think that's the second very important thing. I think it's not a cyclical opportunity. And what do you think? Leave in the comment section down below. With that, I'll see you in the next video. But more importantly, I will see you on the moon. Goodbye!